Okay, welcome back to the second part of chapter 4. Continuingly, we'll talk about the earnings quality, and then we start looking at the operating income and what is demand for operating income's earnings quality, right? We say that the people can, by classification difference, to classify certain items from operating income to non-operating income, hence that can manipulating the operating income to a higher uh, amount to hence that the investor consider the operating income to be more predictable, and then they pay more attention to operating income. And then so let's say just by glance at the Hershey's company's 2016 and 2015's partial income statements, out of all these items, does every items on this list that is associated with, of course, this is an income statement. Is not nothing wrong with it. It's accurate, but you might find this item called goodwill and other intangible asset impairments is nothing to do with the selling chocolate, does it? And also, business realignment charges has nothing to do with selling chocolate as well. And then your question will be, well, if you say that operating profit has everything to do with the core business, then why Hershey can park goodwill and other intangible asset impairment under the operating included in the operating profit also as a realignment charges? And what does realignment charges really mean? Good questions. So first of all, realignment charges, it has another name called reconstruction costs, and then it's including costs associated with management plans to materially change the scope of the business operation. And then it should be recognized in the period the exit or the disposal cost obligation actually incur. But what does that mean? Specifically, it means that a liability, for example, for termination benefits and the corresponding expenses, should be accrued in the required period of work. So, if the future work by employee is not required to receive termination benefits, the liability and the corresponding expenses for benefits are recognized at time companies communicates at the arrangement to employees. And the costs associated with closing facilities and relocating employee are also recognized when the goods and services associated with those activities are received. In other words, that if, for example, the termination benefit for employees, right? If you say you lay off, say 3,000 employee, and then on that day, if there's no future requirement for their services to earn the say $10,000 reverence fee for each one of them, then that day that you communicate this decision to them, say sorry, we have to close down this branch, then you have to recognize $3 million $3 million of reconstruction costs on that day, or $13 million of reconstruction costs on that day. So this is what meant recognize in the period the exits, right, or disposal cost obligation has actually incurred, right? So, for example, a termination benefit payable to employee to be terminated, and then has to be accrued in the periods employee rendered their services. Costs associated with the closing facilities recognized when services and goods associated with those activity are received. And then why is this, what does this mean, be accrued in the periods employee render their services? This means that it usually takes a considerable time to sell or terminate a line of business or to close location of facility. Many reconstruction costs representing a very long-term liability. Right? GAAP requires that the initial measurement of this liability to be at a fair value, which often is determined at the present value of future estimated cash outflow. And company also required to provide many disclosure in the notes section, including years over which the reconstruction is expected to take place. And then, okay, so once we understanding potentially what is the reconstruction, it's basically a cost that to terminate or changing the major direction of your business. It's often associated with employee layoff and closing factory. And then the question here is actually, why would it included in the operating income, right? So this is because that often, right, the reconstructing is a part of the business. So therefore, then some question will be raised that should the financial statement users to attempting to forecast future earning considering these costs to be part of permanent expenses? The answer is yes, but it's not easy answer. First of all, it depends on, it's very contextual. You have to look at whether this company has a historically on every year has a reconstruction costs. For example, Hershey from 2005 to 2016, this is like 11 years. Every year they including certain amount of the reconstruction costs. And then if that's the case, then in this specific case, the Hershey's reconstruction costs should become a part of operating costs, right? And also the question is, will this thing happen again in the future? Then that's also related to the direction and of the company, right? And then probably in Hershey's case, and then also besides Hershey, a survey is conducted for the 500 Fortune company. About 40% of those companies including reconstructing costs in the income statements as operating expenses. And then, so there's the inferences that we can take from here. Financial statement user must interpret the reconstruction charges in the light of the company's past history and financial statements notes disclosure that outlaid the plan and the period over which this reconstruction is gonna take place. In general, the more frequently this sort of unusual charges happen, the more appropriate it is financial statement users to include them in estimation of firm's permanent streams, which is operating income, right? Okay, so the second items listed on the Hershey's income statement is another one called other unusual item that seems not associated with core, but it's actually included in the operating income. The name of that is impairment, right? Long-lived asset impairment. And also issues related to the revenue recognition affecting earnings quality as well. So there's for example, any long-term asset, whether it's a tangible or intangible, should have its balance reduced if there is a significant impairment of value. So what do we define significant impairment of value? It means the market fair value of this, the value of the asset is significantly higher than the book value of the asset. That means that this asset has been depreciated or impaired in terms of the value. In that case, that you have to write down the asset's value on the book. And then also the earnings quality is affected by the revenue issues as well. For example, suppose that towards the end of the fiscal year, right, the company lost a major customer, right, and that our customer cannot be replaced as well. And that would mean that the current year's revenue number, including the amount that this major customer contributed, would not be repetitive or would not be replicable in the future. So in other words, that this part of the revenue that you look at usually in the operating income is no longer exists, right? So therefore, you have to recategorize the revenue associated with this major customer into other income rather than operating income, right? To remind the the investors that this is not gonna be a forward-looking or reliable source of income anymore. And also other issues such as a misstatement of the revenue is also very important item that is including operating income. For example, SEC charges Lime Energy with a reporting non-existence revenue, right? The allegation included executive faking pipelines revenue that didn't really exist, right? So they call it misstatement of the revenue. And the executive will allege that to have a recognized revenue on contract proposals that have been presented to customer, but customer hasn't even agreed to sign a contract. And then there's another name called a premature revenue recognition. So all these things gonna affecting the earnings quality, right? So if you still, first of all, when you're losing a major customer and you still categorizing that revenue under operating revenue, then that the earnings quality of that year is pretty poor, right? Second of all, if you fictitiously creating revenue pipelines or prematurely recognizing revenues, those revenues are not reliable or not even gonna happen. Hence that the financial report you provided to the shareholders, they are focusing on operating revenue. They will find that this revenue number is not realizable in the next year if they think that this is the base of their inferences, right? Okay. So therefore, income statement usually associated with a lot of earnings quality issues. Okay, so now let's focus on what is non-operating income and how we can measure or assess the non-operating income's earnings quality. Sometimes some items in an income statement relate to only tangentially to the normal operation. Tangentially means that not the main little or just a little bit, right? So, and the example of this is such as interest income or interest expenses and gains and losses on sale of investment, right? So, and we refer those items that you gain or you lost or you earn the income or you spending money related to this tangentially items as non-operating items. Right. So let's look at the Home Depot. Right, Home Depot we know it's DIY kind of like providing materials for the home building and reconstruction. So their main business include selling home improvement products, sale of So the sale. So if you look at here, the operating income, this line has already recognized $13,427 million, right? And then this is the 2017 and 2016 income statement. However, under this line, excluding from the operating income, there's an interest in investment income for 36 million, 2017. For interest expenses, they're spending the 972 million versus 2016 for 919 million. And then the interest income or investment income is 166 in 2016. And then the separate listed income before taxes, right? So in other words, they separately listed the income and expenses for non-operating income. This is because that, for example, let's say this interest income or expenses is related to sale of investments, right? The sale of the investment is not the normal business of the Home Depot. So therefore, Home Depot reports these amounts as non-operating items. And then also, Home Depot disclosed the notes of its 2016 report saying that the gains, right, the gains of 166 million is because they sell important investments. And once this investment was sold, their gains were not expected to be continued in the future period. So investor would not consider this kind of gain to be a permanent earnings, right? To be permanent of the profit. And then, as you can see in 2017, this gain is drastically dropped to 36 million, right? So by doing that, it's actually Home Depot did a good job to excluding this interest or investment income from operating income because it's tangentially related to operation. Another large non-operating items reported by the Home Depot is the interest expenses, right? In the 2017 report, Home Depot reported 972 million interest expenses, and then correspondingly, the company also reported long-term debt of 22 billion in the balance sheet. Because this long-term debt will not be repaid, right, for a very long time, for several years, the company will have to pay the interest for several years. Therefore, the interest expenses, right, represent a type of non-operating items that is expected by investors to be more permanent component of future profitability. Okay, so another thing that I want to introduce you regarding the earnings quality about income statement is sometimes people voluntarily disclose non-GAAP earnings. And then companies are required, as we know, to report earnings based on the general accepted GAAP, including all the revenues and expenses arranged in the single-step or multi-step income statements. But nowadays, a lot of companies voluntarily providing non-GAAP earnings, which exclude certain revenues expenses. Okay, for example, they excluding reconstruction costs, acquisition costs, write-downs of impaired assets, and stock-based compensation. What we know is that non-GAAP earnings, although informative in certain aspects, are very controversial, since the expenses that are excluded are not consistent across the firms, across industry. It's majorly at the discretion of the management, right? So that means that the number they're providing using non-GAAP number can be manipulated, can be opportunistic. This year I excluding, say, stock-based option. Next year I excluding write-down of impaired assets. And also from regulatory perspective, the Sarbanes-Oxley Act requires reconciliation, right, between the non-GAAP earning and the earning determined according to the GAAP. So after the pervasive phenomenon of non-GAAP, and SEC come up with regulation SK, and then require reconciliation between the non-GAAP earning and GAAP earnings. Okay, so let's just do a quick concept check about the reconstruction cost, right? So Buffalo Manufacturing Company is reconstructing and closing the Plantium mining division. The mine will be closed and its assets sold off over the course of next 3 years. When should the cost related to closing the mine to be recognized? Okay. So A, in the year reconstruction plan is announced to the board of directors. B, in the years the costs are actually incurred. C, in the year a reconstruction is complete. D, all above. So the correct answer should be B, right? Because as we said, reconstruction costs are recognized in the period the exit or disposal cost obligation are actually happening, right? Are incurred. Okay. So now we finished talking about continuing operation, which is containing the operating income associated with the core business, right? And then we're also including other income or expenses, and then not associated with non-core operation, right? So now, but all these things, both of them, operating income and other income, is all talk about continuing operation, right? And then after continuing operation, there's a concept called a discontinued operation. So if a company decides to sell or dispose the component of their business, profit from this discontinued operation will not continue. Hence, that discontinued operation are reported when one, a component of our entity or group of component has been sold, disposed, or is considered held for sale. Two, disposal represents a strategic shift that has or will have a major effect on company's operation and the financial results. And the income and losses from discontinued operation is reported separately below the income from continuing operation. For example, as you can see, income from continuing operation before taxes is $1,000 and then apply 25% of the tax rate. So therefore, income from continuing operation is $750. And then also, you can see here, income from discontinued operation, $200 net of $50 tax is actually $150 because 200 minus 50 is 150. And then you add up this 700 and 150 together equals 900. This is just example, right? And so for the first item, that so because the discontinued operation represents a material component of a company, companies report result from discontinued operation should be separately in the income statement to allow financial statement users to be aware that this is either gain or losses is generating from operation that is gonna be discontinued. Okay. And also the objective of this format is to inform the financial statement user of which component of the net income, right, are continuing, which part of the net income are continuing, such as this $900, that we know that 750 of them is going to be continuing existence, and then 150 of them is not going to be continuing. And a separate reporting including tax as well, right? The income tax expenses associated with continuing is reported separately. For example, this $250 from income taxes of discontinued operation. Also, in case that there is a loss from discontinued operation, there would be an income tax benefit. Right? Instead of income tax expenses. And losses from discontinued operation are tax deductible and would reduce the overall tax owed for the whole company, right? For example, instead of making $150, instead of have at the end sale for discontinued operation for 200, what if it's a negative 200? And then this negative 200 will associate with negative $50 of tax expenses reduction, which will gonna be applied to the taxes charged for the continuing operation, and hence that this $50 we call the tax benefits. Okay, so so then let's look at there's a two scenario, right? One scenario is that when the component that you decided to discontinue has been already sold before the year end, right? When the discontinued component is sold before the end of the reporting period, the income effect will include. So first of all, you have to recognize two things. Income or losses from the operation of the component from the beginning of the reporting period to the disposal date, right? Second portion of that you have to disclose is gains or losses of the sale of the component asset. What does that mean? Meaning that, saying for example, this year we are beginning on January 1st, 2020. And then you know that you have a component that will be sold, right, soon. So say that it's sold to not until July 31st, 2020, right? And now you are on December 31st, 2020. and then you're reporting the financial statements. So the first thing about, due to you already sold this component of your business, there's the two things you need disclosure. First of all, from January 1st to July 31st, what is the operating income or losses generated by this discontinued operation, right? Maybe it's continue making money for you, it's just not aligned with your main business, or it's actually costing you a lot of money from January 1st to July 31st to maintain it, right? So that's part of it. Another thing is that on July 31st you sold it all the assets, and some of the assets you made money for, and some of the assets you lost money. So by selling this or discontinue this portion of this part of the business, right, operation, how much did you gain or loss, right? So this is two portions that you have to make sure that you include it in the financial statements. For example, right, even though the Abbott, sometimes they sell their genetic, they did it as they wanted to sell their genetic factory related pharmaceutical segments, and then not until the 2015. And it's very important for comparative purpose to separate the effect of any prior year presentation, right? So this allows apples to apples comparison of income from continuing operation. In other words, that say you sold Abbott sold 2015 their genetic pharmaceutical segment. So in 2015, they needed to restate their 2013 and 2014 and the 2015 statements, and then to reclassify the income from genetic pharmaceuticals in 2013 and 2014 into discontinued operation. By doing that, they can inform investors to have a comparative understanding of what would be happening in the future of 2016 without the income from the genetic pharmaceutical segment. And also you have to disclose the notes to inform readers that the prior year has been restated for comparative purpose, right? So another thing that, let's look at an example here. In October 2021, manufacturing of Toothless Holding Company decided to sell one of its division that qualifies as a separate component, right? According to the GAAP, right? And then the division was sold on December 18th, 2021, and consider the following facts related to the division. From January 1st to the disposal, the division has a pre-tax losses from the operation for 5 million, and second, the asset of division has a net selling prices for 15 million and a book value of 12 million, right? So that means that when you sell it, you can sell it for 15 million and the book value on your book is only 13 million. So Toothless income statement for 2021 beginning with after-tax income from continuing operation is actually 20 million. So this is a continuing operation of 20 million is reported as after tax. Would be reported as following, right? Income from continuing operation is 20 million, and the discontinued operation, how we do that? We have to report both, right? So you have a gain of 30 million because 15 million minus 12 million is 3 million, and then you have a loss on the operation for 5 million. Hence, the total up, you have a $2 million loss. So therefore, you will report a loss from operation of discontinued component for 2 million. And then you actually creating tax benefit out of this 2 million, right? Basically, because 2 million multiple 25% is the 500,000, and this $500,000 is gonna increase in the operating income, right? Because this tax benefit is reduced tax expenses. So therefore, the loss on the discontinued operation after tax benefit, right, is gonna be 1.5 million, and then hence that the net income should be 20 million minus 1.5. 20 million minus 1.5 million is 18.5 million. Okay, and then reporting the discontinued operation, there's another scenario is that you didn't sold it by the end of the year, you still held it for sale, right? So when the discontinued component has not been sold when the reporting period ends, right? The income effects are reported but modified, right? In other words, you still need to report income and losses from operation of the component from beginning of the reporting period to the ending of the period. And at the same time, you have to report an impairment loss if the book value and the asset of component is more than the fair value minus the cost to sell. In other words, you have to assess whether the discontinued operation is suffering from impairment loss, which is the book value is less than the fair value, right? So that means that let's look at this example. Same example. What is the difference is that on December 31st, right? This company's physical year end, the division still haven't sold yet. But the company considered two items related to the reporting purpose. The first item is that the division reported pre-tax losses from operation for 5 million, same as what it was before. And at the same time, December 31st, this company's executive assessed that the assets of the division had a book value of 12 million and have a fair value of 9 million, right? So that means that if your book value is 12 million and the fair value minus anticipated cost is only 9 million, that means you had incurred about a $3 million of loss, sales loss, right? Right. So therefore, you not only have to recognize the loss of operation for discontinued operation, at the same time you find that this discontinued operation also, if you sell, you're still gonna lose the 3 million. So on the income statement of 2021, so this is gonna happen, right? It's gonna look like this. For 20 million of gain, the operating income, continuing operation income, the discontinued operation income, which is gonna be incur losses, which is gonna be let me wipe this out. Right, so the loss of 3 million plus loss of 5 million, right? It's gonna be loss of what, 8 million, and then 8 million can generating tax benefit of $2 million, and therefore the loss on discontinued operation in total will be $6 million negative, and hence that the net income will become 14 million. Okay. So let's look at some examples for another one. Let's say the discontinued operation for Abbott, right? So in this example, the discontinued operation, the following are summary the asset and liability held for the disposition. For example, this Abbott, so important information about the discontinued operation, whether it's a hold or sold is reported as in a disclosure notes. So this is in the note section, right? And the note provides additional details about the discontinued component, including its identity, right? And its major class of assets, and also current liability associated with that specific discontinued operation, and all kind of liabilities, right? And the reason for the discontinuance and the expected manner of disposition if held for sale. For example, this specifically we know that the discontinued operation of Abbott has 513 millions in the assets, current asset, and it has about 245 million in terms of current liability. Okay, so let's look at this example. The Casella baseball bat, a company reported income before tax for 375, right? And this amount including $75,000 loss from discontinued operation. Right? And the amount reported as income. So the question is that what is the amount reported as income before? What is the amount reported as income for continuing operations? For if the tax rate is 25%. So this one, what we can do is that, so this company reported income before taxes is 370. So here is 375,000, right? So that means that the continuing operation net income should be this number. So that's why that's 375,000 plus 75,000, right? So that means that it's gonna be 4. Wait, 1, 2, 3, 4. Right? So 450,000. Yes. So and then this 450,000. That's you restated, right? Minus 75,000, so 375,000. This is income before taxes, right? And then this 450,000 is it says amount of reported income from continuing operation. Usually it should be net of tax, right? So therefore, you will need to use this 450,000 multiple tax rate 1 minus the tax rate, and which is gonna be 337,500. Okay, so it's gonna be the B. Okay, the second question. On October 1st, American Medical Inc. adopted a plan to discontinue its genetic drug division, which qualifies as a separate component of the business according to the GAAP regarding discontinued operation. The disposal of the division was expected to be concluding in March 30th, 2022. So therefore, on December 31st, 2021, the company's year ended. The following information related discontinued division was accumulated. So the operating loss for that genetic drug division was 195 million. And the excessive book over the market value less the cost to sell is 25 million. In its income statement for the year ending December 31st, 2021, American would report a before tax loss of discontinued operation of how much? It should be 195 plus 25, it's gonna be 220, right? So it's gonna be C. Okay. Another one is the Trident Corporation's result for year end December 31st is as following: sales revenue, cost of goods sold, selling as SG&A, gains on sales of investment, and loss on discontinued operation. Right. So we know that this is a part of the operating income, and this is a part of, and also this one has to be in here as well, right? So this is operating income. This is operating, including this is other income, other operating income, right? And this one is gonna be discontinued operation. So in another word, so sales revenue minus the cost of goods sold, and this is the gross profit, right? And then we have SG&A costs, and then we have so therefore we have reconstruction, and then we have a reconstruction cost, right? And then we got operating income. And after this operating income, we have other income or loss. So we have a gains on, which is the gain, right? Which is the gain on sales. So this is gonna be 82,000, 100,000, and 4,800,000, and SG&A is 2 million. And the reconstruction cost is 280,000, and the gains is gonna be this gains this is gonna be 300,000, right? This is the positive, right? Positive, so we keep it. Yeah. So this whole thing right here is results from continuing operation, right? And then we have to plus the loss on discontinued operation, right? So therefore this is a separate from continuing operation. So the question is the change in corporation income from continuing operation before the income tax exists. So we're just adding 8,200,000 minus the 4.8 million minus 2 million minus 280 plus 300,000, and then it's gonna equals to 1,420,000. So in other words, we wanted to exclude this item because it's a discontinued operation. Okay. Okay. So next video, I'm gonna talk about accounting changes. Okay. So I see you in the next video.